Stocks continue to drift with frontline indices little changed, but declines outnumber advances. IT and telecom eke out some gains, with financial capital goods are prominent drags. Mid-caps underperform. Edelweiss exits Nuvama Wealth, racking in over 1,700 crore rupees, while an investor offloads over 700 crore rupees worth of Newland Lab stocks via block deals. This even as Zaggle and Gravita line up QIPs of near 1,000 crore rupees each. India is seeing pressure on consumption, FMCG major tells CNBC-TV18, but they are hopeful of a pickup in demand in a few quarters. Godrej Consumer calls the slowdown seasonal and transitory, while Britannia eyes a strong FY26. Consumer price inflation is expected to come in at 5.5% for November, CNBC-TV18's poll indicates. This would be below RBI's upper permissible limit, lower than the previous print, but food inflation is likely to remain high. Chief Economic Advisor V. Anant Nageshwaran sticks to the 6.5 to 7% growth estimate for the current fiscal year and expects the Q2 number to be revised higher as more data comes in. Hello, good afternoon. You've tuned into CNBC TV18 and you're watching Business Lunch with me, Vinny Motiwala. A quick look at what the market is doing. Again, today what we're seeing coming in was pretty much a rainbound session. Then at 12:30 approximately, we saw a slight bit of a further fall coming in for the markets, but it's remained in the 24,550 to 24,600 range. Open in the green, but then couldn't maintain that, and then has been in the red territory. That's what the Nifty is looking like. As of now, it's down 0.3% in trade. Let's look at the top drags that are coming in for the Nifty 50 in terms of contributors. Also, you look at it, something like an L&T. Reliance is a heavyweight. You have HUL as well as SBI among the top drags that are impacting the Nifty contribution today. So yes, keep an eye out on that. Not a pretty picture coming in, especially from the FMCG side. Mid and small cap, what the broader market is doing today. Small cap is a clear underperformer today, down 0.8% in trade. Mid cap is almost just slightly below what the benchmark indices are doing. So yes, watching out for that. But advance decline ratio also clearly in favor of the declines today versus an advances. So not a pretty picture coming in. IT sector is the only, actually IT plus media now, that has shifted to the green territory as well. So IT sector as well as media now are managing to hold on to the green side. So keep an eye out on both the names, because in IT also all these top IT companies like Infosys, TCS are holding on to gains. What is lagging today? I beg your pardon, media is down. Metals, I meant Nifty Metal, that's the one that is holding on to gain as well. So let's pull that up, because that's also just moved into the green territory as of now, like you can see. Media, auto, FMCG, top sectoral losers. Adani stocks, they are buzzing in trade today. So keep an eye out on Adani Green, Power, Energy Solutions, all these Adani names are buzzing. And shipbuilder stocks today, let's pull that up. Cochin Shipyard, Mazgaon Dock, Garden Reach Shipbuilders, all of them also are holding on to some bit of a gain there. But that's how the market setup is looking like. Benchmark indices quite, in that range that we're seeing coming in. But let's move on. And a big block deal in Nuvama Wealth earlier this morning is what we saw. 8.4% stake worth around 2,100 crore rupees change of hands is what has happened. Now, speaking to CNBC TV18, Edelweiss Group's chairman Rashesh Shah confirmed the stake sale by Edelweiss Group subsidiary, that is Edel Finance and ECAP Equities, and said that these proceeds would be used to reduce the debt in Edelweiss Group. Let's listen in to his comments and furthermore what he had to say.
Nuvama is still, a lot of the Nuvama shares are still held by the Edelweiss shareholders. If you remember, we had distributed 30% of Nuvama shares to the Edelweiss shareholders. So the Edelweiss shareholders are still fairly invested in Nuvama. Me and my family, my entire extended family and all, which are all shareholders, we got shares in Nuvama in pro rata share of our holding in Edelweiss. So we own about 24% in Edelweiss. So out of the 30% which was given to the Edelweiss shareholders, we got the pro rata on that, out of which we keep on managing that as an investment portfolio. So that is what we got in the original demerger. For Edelweiss, out of this money that comes, a large part will go towards repayment of debt. We have almost halved the debt at Edelweiss Financial Services. And as you know, we have also announced that we are going to sell a stake in a mutual fund, and we are IPOing our EAAA, which will also give us more liquidity and capital to reduce the debt even further. Collectively, if we get between 3 to 4,000 crore, and as I said, our current debt will fall below 5,000 crore, that in the next 1 year, we'll get close to, under 1,000 crores of debt is what we are aiming for, what we are hoping for. There is a secular trend up, not just for Nuvama, but for wealth management companies, for asset management companies. I think India is at that crossover stage where, being a very bank-dependent financial services country, we have become bank plus capital markets.
Okay, now let's move on. And the FMCG industry is facing a demand slowdown, and industry heads assure that the pressures are transitory and the coming quarters will see some recovery. Listen to some of the excerpts from the conversations that we had with some of these industry heads.
Bulk of the issue has to do with the increase in oil prices, which a lot of industries are facing. Palm oil prices are up 50% in the last 6 months, and soaps uses a lot of palm oil. So margins get affected when palm oil prices go up. When you take up consumer prices, volumes fall. But these are things we've seen before. I mean, we've seen different palm cycles before. We're in the middle of a highly inflationary palm cycle. And since our diagnosis is the issue is transitory, we should go back to our growth trajectory. There might be a little bit of issue in the soaps for a few more months, but broadly speaking, we expect things to improve.
Rural demand has picked up, and that's been seen across all companies, while the volumes have been under stress overall we're seeing urban a little slowing down, and also there has been a channel shift that's happening in the urban side as well. I think the trend will continue for a quarter or two more in terms of that, and after that I think FY26 would be quite a strong year for the entire FMCG sector to bounce back.
But yes, I think by end of the year, for this quarter, certainly, that kind of price would go up. And in terms of volume, of course, with the prices going, so much high, so there would be a little bit of impact on the volume growth, but still it will be a high single digit or a double digit growth for sure. With these kind of prices, unforeseen stuff and all the prices not being able to pass, I think this would impact, say, by about 100 basis points.
Okay, on that note, we're going to slip into a very short break. But up next, we'll talk about India's CPI inflation number for the month of November. Will be released later today. We'll get you what to be expecting after the short break. Welcome back to Business Lunch on CNBC-TV18. Let's shift focus and talk about the CPI data in India that is expected today at 4 p.m. and this is going to be for the month of November. A CNBC-TV18 poll sees that November CPI at 5.5%, which is below the MPC's mandate of 6%, but food prices are still high. Now, Lata is joining with us to give us more details on this front. Lata?
Yes, the poll does see that the November inflation will be 5.5%, which will be a relief. Because look at the October number. October number was 6.21, above the MPC mandate. And basically, that is the upper level of the mandate. The MPC's mandate is to keep inflation at 4%. Even at 5.5%, we are a distance away. And God forbid if it comes a little above that, because there are quite a few people who have readings between 5.5 and 5.8. But as you said, we have to worry about food inflation. Before I come to that, core inflation, that's expected to come in at around 3.7, much like it was in October. That's not been a problem. Year ago also it was 4.1. So that's well within that 4% mark. But food is not behaving itself. It is still seen at 8.5%. And just look at the year ago number. The year ago number is 8.7. Which means we are rising every year at 8 to 9% on food prices. Tell me which rural person or urban person's income is rising at this point, which means you're actually seeing lower real incomes as far as people are concerned. And as far as the bottom half of the country is concerned. So it is a matter of concern, and everybody will watch out for that. Tomatoes, onions, potatoes, what you call top, because that's, staple vegetables for people. The consolation is that normally during December, Jan, prices tend to fall of veggies. So this may be the last of the bad 5.5% number. We also get the October IIP number. Not very significant because it's like a slightly lagged data. That's expected to come in at 3.5%, largely because the base was very high at 11% last October, which was all those festive month preparations. But more important, of course, is CPI because interest rate policy is based on it.
Thank you so much for that, Lata. But moving on, the Chief Economic Advisor, Anantha Nageshwaran, sticks to the 6.5 to 7% growth estimate for the current fiscal year and expects the Q2 number to be revised higher as more data comes in. Listen in.
It is not that we think that the second quarter slowdown is purely a data artifact, and as more data come in, it would automatically be upgraded. Numbers would be revised higher. Or for that matter, it could be a simple seasonal factor because of rains, because of some religious observance in September, etc. But nonetheless, I think the fact remains that we will be on track to achieve the kind of growth numbers that we had penciled in the economic survey in July, somewhere between 6.5 and 7 for the whole financial year. The private sector is also beginning to deploy its capital with the much better balance sheets, much better profitability, and that we think will continue. So in that sense, we do see this number heading towards the mid-30s in the course of the next 5 years. That there was a spike in global uncertainty, there was a spike in global supply chain disruptions because of the war in Middle East or the conflicts in Middle East and the ongoing conflict in Ukraine, etc. But please believe me that it is not something that will be something temporary. As I mentioned in the next 5 on the left side, these are going to be enduring challenges and we need to accept them. And that is what will also dictate what the trend growth will be. With all our imperfections between 2003 and 8, in fact, there were even more imperfections than now, we could achieve 8 to 9% growth in real terms for 5 years between 2003 and 8, because the global environment was far more conducive. And therefore, we cannot take that for granted. And that means we have to double down much more on our domestic efforts.
Okay, on that note, we're going to slip into a very short break. But after the break, we'll get you more news and updates on the market, stock-specific action that we'll talk about as well. So stay tuned in. Thanks for staying tuned into Business Lunch on CNBC TV18. Now let's shift focus onto some global macro cues that we have. The US November CPI inflation report came in line with the expectation and clearing the way for Federal Reserve to cut interest rates in a December meeting. But what do the former Fed officials have to make of this data point? Let's listen in to their opinions and what they had to say and think about Federal Reserve's next move that could come in December.
I think there's going to be really interesting discussion at the upcoming FOMC meeting. These numbers are coming in as people expected, but they're not great numbers. And you see a stalling in this path down to 2%. It is true that from a point of view of the real interest rate, which is the interest rates adjusted for inflation, which is what really does affect the economy, there's some restrictive policy here. However, we're in a situation where there's other elements of the financial markets that are very buoyant, particularly the stock market. So there's really a situation here where the Fed may not really be restrictive enough given the numbers. So they sort of don't want to surprise people, so that it's likely they're going to cut at this meeting.
As you know, they're discounting about 99% now of a likely cut of a quarter. The economy's doing well. Powell keeps talking about this. Financial conditions are wonderful. Look at what happened here on the floor today. So financial conditions are very accommodative right now. A lot of private capital out there, private lending and so on. If I were at the table, I would say let's pause, but I'm not at the table.
Okay, come on, and now let's actually look at what the market is looking at like right now. While it's a range-bound trading session, we're not seeing much of a move coming in, but Nifty is almost near the day's lowest point again. We're seeing 24,560, 550 levels holding on for the Nifty. As of now, Nifty is down 0.3% in trade. Like I mentioned before, also the broader markets, that's seeing more of a pressure today. So mid-cap and small-cap clear underperformance coming in. Let's pull up some of the names that are in focus today, and we are seeing sharp declines coming in here. We have Nalco that's in focus as well. Nalco is down 7% in trade, so let's keep an eye out on that one. It's not doing anything exciting today, and that is what one should be watching out for. We have Nuvama Wealth that's in focus. We have Jubilant Food that is down also in trade of 4 to 5%. Concor also is under pressure today. So yes, that's what we're seeing in terms of pressure coming in. But a quick look and moving on from the markets, we have ECB is set to take the rate decision later today. Markets are pricing in another rate cut. Let's go across to CNBC's Annetta Weisbach, who's joining in with us to give us the expectations.
Well, we're expecting another rate cut of 25 basis points today, and also that we get an update of the staff projection, and for the first time projections for the year of 2027. So what's expected when it comes to them is a downward revision of GDP growth, and also a slight downward revision of inflation for this year, because inflation did come back more forcefully than expected, though it's still sitting a tad too high for the liking of the ECB. That's why they stick to the rather timid approach to cut rates of 25 basis points each time. It is the fourth consecutive rate cut. And of course, the key question for the press conference today is what is going to happen next year. And here the opinions range from between they'll keep on cutting rates until they reach a terminal rate of 2%. Some see the terminal rate even sitting at 1 to 1.5%. So the market is currently pricing in 150 basis points of rates cuts during next year. And that is because inflation is expected to come back steadily to the target of the ECB, while we see economic growth actually souring across the euro area. We had those PMI figures late November, which were really a negative surprise, especially for France. Of course, we need to talk about the political insecurity here as well. Especially France will be the elephant in the room here as well during the press conference, given that there is no government in place, and that is going to be very tricky to find one. And also the fiscal spending aspect will be an issue for the ECB. So I guess this is the mix they are operating in, but for today, 25 basis point rate cut is baked in, and of course a new round of staff projections. With that, back to you.
Okay, thank you so much for that update on that front. But, Nifty not doing anything exciting, 0.3% of decline. Let's see the next couple of hours whether that's going to be headed, because it's a weekly expiry. So we do see some bit of a volatility. That is something we're watching out for. Nifty Bank also today is under pressure, and that is down 0.3% in trade. But yes, that's how we'll be ending the market. Not much of an excitement that we've seen in the last half an hour specifically as well. And it's going to be a goodbye from myself as well as the team who put this show together. Thank you so much for tuning into Business Lunch. Up next, you have Midcap Radar.